Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
And hello to those of you that will be listening at home, and I hope that your exam study is going well. Now, before we start the lecture today, I'm going to actually hand it over to Alex. I try not to say too much in terms of selling the Student Managed Fund myself because it is one of the courses that I oversee. Alex is our CIO. You started last semester as the relationship manager when at the time I think you'd only done Foundations of Finance, right? She was the best relationship manager we could have asked for, and she is now the head of the fund. So rather than me talk about the fund, I have asked Alex to talk to you guys quickly about it, and then we'll get into the lecture. So Alex, over to you.
Thank you, Anna. So the mic is a little bit short for me, but it's fine. So hello everyone, and to those who are listening to the recording later on, I'm the Chief Investment Officer of ANU Student Managed Fund. Now I'm going to have a little brief introduction of our fund, and also the prerequisites and application form will be attached in your Voter forum. So Student Managed Fund, if you search online, FIM 3K9 or 3K10, is an undergrad course which requires 12 units of enrollment. We require this because we want the overlapping cohort can pass on the culture and values of our fund. Our fund will allow you to have a daily, day-to-day operations of a real fund management area. We are running the real money of about 0.6 million, and now we're making return from some of our investments. So I'll have a brief introduction of each team and its prerequisition according to the word. Oh yeah, no, it's fine. You sure? As you can see from the fifth line now, active Australian equities teams, which that we are conducting stock research right now. We have finished our investment process so far. So this team has been running really good so far, and we are intended to conduct some investment recommendation at the end of the semester. Following the asset allocation team, which is a team that trying to build up the investment process so far. The larger purpose for this team is to allocate different types of assets, including some assets class that we have learned in this course, both equities and other stuff. Later on followed by will be risk and compliance team. What they're doing that they're trying to make ensure that our investment follow the ANU investment policy, and also there's our risk that the fund will face in later on. Last but not least, relationship team that they're in charge of the external communication of the fund. So normally in one of the semester we'll have 2 to 3 IC meetings, which that investment recommendation are ensured to go through the professional industry insider and our donator to make sure that we conduct a consistent relationship to those people who are in need. That's the final goal of our fund. Yes, so my personal experience that is a very rewarding experience. I learned this from one of my course from as well, and I attended last semester, and it's really rewarding. I work with a lot of people that are really working towards the value and the goal that we're trying to achieve. I have some of the members in the class right now as well. They're really excellent and good to work with. Also, it's a course that will increase your employability because you're getting attached to the real industry management in Australian environment, especially they are really environment of fund management. And the last thing is I would like to introduce our convener Anna, that I have been working with her since last semester. It's a small people environment, so I have a lot of chance to talk to her, and she's really nice and help with us from hand to hand, although students will lead the whole process. So if you are interested in the fund, please look at the forum, and also if you have any questions, please email Anna, or if you have any other question you want to talk to face-to-face, I'll be sitting in the middle of class. This semester I enrolled into portfolio construction as well, but I'm in a fund for the second semester as well. Thank you so much, everyone. looking forward to see your applications.
Thanks, Alex. It really is, it's for those of you in undergraduate, unfortunately, it is only offered to undergrad because the masters don't have enough time in their programs. But if you are in undergraduate and thinking about the application, I understand that it takes time to write the application process when you have a lot else on, but it's one of the most inspiring things that I've been involved with. The people in the fund are phenomenal. They do find that it helps with their employment, and one of the things that I've really noticed with this course is how much people are enjoying the fact that it's related to the real world. You don't get any more real than actually managing money in a way that's going to benefit the lives of future students through scholarships. So I do encourage you guys to apply. It's better coming from people in the fund than it is from me, but keep it in mind over the holidays. The applications are due 21st of September. Okay, so what we're going to be doing today is equities. Now, by the way, I've put a notice up on Wattle. It might not have been sent out to you yet. For those of you that like to print off your lecture slides, I have updated them significantly this morning. One of the reasons for that is that, as I'm going to say at the end of today, the course feedback link is now open on Wattle. It's going to stay open until the 14th of September. There's been some early respondents, which is fantastic. I know that it does take a little bit of time to fill out. It's only a couple of questions, but I really would appreciate as many people filling it out as are willing, because I do take the feedback on board. It's so useful to see what is contained in the course that you guys like, what you guys would rather changed, tweaked, whether you like the fortnightly tutorial setup, for example. So you'll see that when I start to see that the class wants to move in a certain direction, I'm teaching for you guys, and I like to actually apply that. Now, there's only been, a small proportion of respondents so far. One of the things that there has been a suggestion on is something that I'm not hugely surprised about, and that is a suggestion that there's a bit more content on the slides. This is a constant battle with this course, partly because the examples that I give might have happened in the last day or two, and partly because I get concerned when everything is on the slides. I get concerned that it makes it very easy to try to rote learn the material. I speak from experience. I used to do it as a student at times myself. So I like it to be more about listening and understanding and discussing. And when I ask you guys questions and that shapes a solution, I sort of don't know ahead of time where the discussion might go. But I do fully understand why you would like more content to be written on the slides. You've asked, I've answered, so I've beefed up the slides for this week, and I will continue to do so as the weeks progress. So if you're wondering whether to fill out the mid-semester course feedback link, if there's something that works and you want it to continue, when I see it, I keep going with it. If it's something you'd like adjusted, if a lot of people are asking for it, so I feel like it's what the group wants, I go with that as well. So apologies if you have printed it out, but hopefully you will be pleased that there is more elaboration on each slide. So what we're going to do today is start to look at the individual asset classes within our broad multi-asset class portfolio. So up until now, what you've been doing is learning the tools to help you with your quantitative asset allocation. So you've learned that it has to start with the investor objectives. You then decide how you're going to model your asset allocation framework. And then most of the things that you've looked at, with the exception of a strategy like the fundamental risk approach, most of them involve going to the data, going to a computer, and coming out with an initial asset allocation. Now, I say initial because we've also said that data has flaws. So there's a lot of things that a computer can't pick up through something like optimization, where you need your common sense and reasoning to come and adjust the asset allocation based on things that a computer can't do for you. One of the best ways to do that is to understand the underlying nature of each individual asset class. So that's what we're moving into now. And to give you an example, because it's one that you guys will have to do with the assignment. So the assignment, for those of you that haven't seen it, is up on Wattle. And if you have a look for what your clients have given you, you've got two clients. They have asked you to provide a recommended asset allocation for them. They have provided their objectives and constraints. So remember, step one, who is the client? What do they want? That's what you see here. They have then asked you to provide an asset allocation using two steps. The first is they've asked you to perform quantitative analysis to come up with an initial asset allocation. The second step is that after that, you then would apply qualitative considerations to adjust the allocation from step one to then arrive at a final set of weights. Okay, so the reason that I've actually written the assignment this time asking you to officially follow those two steps is that is very reflective of what tends to happen in the industry. And it actually neatly follows the process that we're taking in the course. Where have we got it? So if you have a look here, if we take Abigail, for example, you can see that she wants to minimise risk, subject to a lot of constraints, whereas Robert wants to maximise return, subject to a lot of constraints. Actually, no, let's go with Robert. Robert wants to maximise return, subject to a lot of objectives and constraints. Remember, one of the issues that we've said about direct property is that it's appraisal-based, so the returns tend to be smoothed. When you ask an optimiser to maximise return, it will tend to want to jump to things like assets with appraisal valuations because they're going to have understated volatility, so they look good on a risk-return trade-off basis. You therefore need one constraints to calm down the optimiser that are more reflective of reality. So, for example, Robert has no more than 30% of the portfolio invested in illiquid assets, such as direct property and private equity. But the other thing you need to do is have the overlay of qualitative considerations. Have a look at what your optimiser gives you, and it will be different for different groups depending on how you set it up. Have a look at your direct property weight and ask yourself, is it too high? Do I need to slightly bring it down? Because the optimiser, if you use optimisation, is giving too high a direct property weight because of the issue of appraisal valuations smoothing the data. So what we're going to do from week 6 through to week 10 is give you some of the different areas where you might want to bring in qualitative considerations based on a deeper understanding of each asset class. By the way, everyone should have formed an assignment group. If you haven't, please contact me as soon as possible. So equities is obviously the natural starting point in which to have a look at each individual asset class, because it is the biggest asset class that features in most people's portfolios. What we're going to do today is we're going to start by looking at the roles that equity play in an overall portfolio. We're then going to look at the risk and return properties of equity. We're going to first look at it in terms of the overall equity market, and we're then going to look at it within an equity portfolio. Right, because if you have a passive exposure where you invest in a broad equity index, then you're going to be exposed to the overall equity market drivers, but you will have diversified a lot of the stock-specific or industry-specific or size-specific factors away. But if you're taking an active, more concentrated investment within equities, you need to be very aware that you don't have big exposures in particular fundamental risks that actually will bring, for example, a big risk of shortfall to your portfolio in times of economic crisis where you might be having risks in the job market as well. So it's not enough just to say what is the overall volatility of equity. It's also important to understand what the different features are of the different equity strategies, because ideally if you have a broad multi-asset class portfolio, you want to start diversifying between those strategies. So what we're going to talk about today, for example, is it's fine to give your money to a really good small cap equity manager. But if you're running a multi-asset class portfolio and you do multi-manager investing, give your money to a really good small cap manager, but also give some money to a good large cap manager. Give some money to a good value manager and to a good growth manager. Right? It's fine for a manager to specialise in a particular area because that's just playing on skill. But if you're sitting back allocating a broad bucket, you want to pick the best manager of different styles so you can start to diversify the risk of any one type of portfolio. So based on that, we're going to look at the different investment styles out there. We're going to look at the different subclasses of equity, and we're going to finish with ways to access equity markets. Okay, so let's start with the role of equities in the total portfolio. Essentially, equities is seen as your growth asset, right? The two big asset classes that are easy to invest in historically have been public equity and public fixed income. Fixed income has been seen as your safe asset. Equities has been seen as your higher risk, higher return growth asset. So if you want to get an additional return in your portfolio, traditionally you will tilt towards equities and away from fixed income. Now, do you guys remember back in week, in fact, I'll get it up, when would it have been? I think about week 3. Let's have a look. Remember, we had a look at the asset allocation of different superannuation strategies. And we went from conservative all the way up through to high growth. If you have a look at what happens when you go from conservative through to high growth, remember what happened is you dialed up your weight in equities and you dialed down your weight in fixed income and in cash. Okay, so if what you want from your portfolio is growth, equities is the way you're going to do it, or at least it has been traditionally. We're now seeing a bit of an expansion into the alternative space as well. The reason, though, it has been the dominant growth asset in the portfolio is that it's widely available. There are other asset classes that are higher risk, higher return. There's private equity, there's hedge funds, there's value-added and opportunistic direct property. But all of those asset classes are harder to invest in. It is very easy to go and buy equities on the public exchange. The next feature is it tends to dominate both the risk and the return in most portfolios. Now, we actually spoke about this in week 5 when we looked at the fundamental risk approach. And you've seen this graph before. It was in lecture 5. I will tend to do this. I tend to repeat the odd bit between lectures. It's to help you guys tie the different weeks together. Remember, what we said is, it looks, when you look at the black bar, like it's 3 big asset classes, equity, property, and fixed income, that drives the volatility in your average growth superannuation portfolio. In reality, though, property and fixed income have very little influence over the volatility in these portfolios. What's driving it is almost entirely equities. Over 90% of the variation in your portfolio is going to happen because of the variation in the equity market. So that's for 2 reasons. One is, as we're going to see in a couple of slides, equity is one of the riskier asset classes to begin with. The second is that it's also one of the highest weights in most people's portfolios, right? So you've got a very high weight on a very risky asset, so it shouldn't be surprising that it's going to drive the time series variation in returns. But it also means that it's really important to understand the equity market drivers, to understand the risks inherent in this investment class, because they're going to be some of the biggest risks inherent in your portfolio. One of the big benefits of equity is that it's liquid, right? I've put mostly there because there are, for example, some small caps or frontier emerging market stocks that aren't that liquid. But typically, you can always buy equities at some kind of price whenever it is that you feel like trading it. So it's very, very rare that you'll be stuck with a perm in equities. And most of the time, you shouldn't need to take too big of a haircut either. So that's a big benefit. And another claimed big benefit of equities is that there are a lot of active managers out there promising to produce you alpha, right? That additional risk-adjusted return. I say claimed because it really does depend on the market, right? One of the problems is that there's so much attention being paid to equity markets. There are so many resources being thrown at trying to beat equity markets. What is happening to stocks is reported on the news every night. There are analysts out there, there are commentators, there are fund managers, there are private traders. Everyone is sitting there trying to beat the equity market, and obviously not everyone can. But as everyone tries to find mispriced stocks, the very process of doing that is going to push things towards their fundamental value. So because there are so many people out there trying to beat the equity market, it actually ends up being a very efficient market, which means it's very hard to beat it, right? Excess returns are hard to come by. So there's a lot of people claiming to create alpha. There's a lot of people trying to create it. Unfortunately, by virtue of doing so, they're making the market very efficient. So it becomes quite hard to beat. Now, the biggest example of that is something like the US, right? It's such a transparent, overanalyzed, oversaturated market that the average manager underperforms their passive competitor. Things like emerging markets, in Australia, the small cap space, there is still potential to generate alpha, and the average active manager does still outperform. But the bigger and the more popular the market, the harder it is on average to get your excess returns. So don't believe every active manager that says they're going to beat the market. Any questions on any of these roles of equity? Yeah. Yeah. That's a really good point. So there's a huge spread within equities. Blue chips, within equity, your blue chip mature companies are typically much lower risk and don't offer as high a return as a result. But that said, if you take your standard blue chip and compare it to a government bond, your blue chips will still have more volatility and higher returns on average. So within equities, the more established, the larger, the more mature the area of equity that you're looking at, the less risky it is. And if you want to have a low-risk equity portfolio, one argument is you just go passive, because then you have the benefit of diversification. But another argument is that you diversify, but within that blue chip space, because then you don't even have the influence of the more volatile stocks in that. But even the safest of equities, on average, tends to see more volatility than the same market's fixed income. And by that I mean your low-risk AAA corporate or government fixed income, by the way. What we're going to see next week is, funnily enough, junk bonds. Does anyone know what a junk bond is? High default risk, exactly. Junk bonds behave a lot like equity, right? And the reason is that when company profits are down and stock prices tend to be lower, at the same time, because profits are down, it's really, a company starts to struggle to be able to repay their debt. So if you already have a high probability of default, the value of your bonds is going to really fluctuate with the profitability of your company, which is correlated with the overall equity market. So a junk bond is going to behave quite like equity, but a corporate high, what we call investment grade bond, or a government bond, tends to be less volatile. Any other questions? There's a smaller number of you guys today, so I figure if you have any questions, we've got the time to answer them. Just ask as we go. Yeah. Frontier markets? Good. So I'm going to actually get to that towards the end, but with emerging markets, you can define it as your more standard emerging markets. So this is 4 down. Things like China, Thailand, Brazil. They're emerging, but the markets are becoming more established, which makes them a bit safer. Frontier markets, and I've got examples here, Argentina, Croatia, Kenya, they tend to be even further out on the high-risk, high-return spectrum. They tend to have difficulty in accessing the markets, lower liquidity, higher price impact costs. I'm going to come back to this. And it's also harder to find a good manager in these. There are fewer managers operating in the space. So I'll come back to that at the end, but a frontier market is one of your more extreme emerging markets. All right, so if we move to the return within equity markets, when people talk about the return in the press and in academic articles, what we tend to focus on is something called the equity risk premium. Now, just quickly, I'm just looking if I've written it there. How do you calculate the equity risk premium? Yeah, it's the equity return less the risk-free rate. So the equity risk premium is the additional return required or expected on equities to compensate for the fact that they're riskier than something like bonds. Right? We compare it to the risk-free rate because that is your standard. That's essentially the return you would expect if you're not going to take on risk. Equity is your risky growth investment. If you're going to take on the risk of equity, what is the additional return that you require to compensate you? So when we talk about the equity risk premium, we're talking about equity return space. Now, historically, the equity risk premium has sat in a band of about 3 to 6% on average across many different markets. Now, there's a few issues, though, with saying that. One of them is that even though historically in the past the average equity risk premium has been in between 3 and 6%, that's actually too high based on what theory tells us, right? It seems too high, even with the additional risk of equity. It shouldn't require that much of an additional premium unless investors had extreme risk aversion, far higher than what we see in reality. So we have what we call this equity risk premium puzzle, which is, in other words, is why are we demanding so much more return based on the additional risk of equities? It seems it's fair that you demand a higher return, but it seems like that return is too high. Now, one of the issues as well is that everyone tends to think about the equity risk premium as somewhere between 4 and 5%. 5% is really commonly said. I've added an additional supplementary reading today. Actually, I think I've got it up here, which is the 2018 Credit Suisse Research Institute fact book. I also have a 2013 fact book in your supplementary readings, but this is really interesting because it gives you a really nice diagram in Chapter 2. It's only supplementary, but I wanted to draw your attention to, here we are, just how varied the equity risk premium can be across the world. Start with some countries like Belgium and Norway. They're at 3%, maybe a touch above 3% is the historical average. Japan is well above 6%. Australia is high, we're nearly 6% as our equity risk premium. We've had a very, well, I say strong, it's higher risk, but a strong returning equity market historically. And the US is so the blue is versus bills, the green line is versus bonds. The US is well above 5.5% against bills, and it's well above 4%, towards 4.5% versus bonds. But the world average is quite a bit lower, and then of course you've got a lot of countries that are lower than that as well. So people tend to say, oh, equity risk premium, 4-5%, yeah, it's high. And they tend to, when they model, take the risk-free rate and chuck on quite a big equity risk premium. But you've got to be really careful what market you're looking at. That might be fine for Australia. In fact, if anything, it might give a bit of conservatism, which is good. But you've got so many countries, including the UK, which is one of the biggest markets out there, where you're going to massively overestimate the return on equities. Now, think about the problem here. You're doing an asset allocation exercise, and you are going to come up with an expected return on each asset class. You're going to look at a world equity investment, but you're going to use the commonly cited 5+% equity risk premium based on the US, right? So you're going to put in an expected equity risk premium above 5%, and you're going to use that when you get your world equity expected return. You're then going to use mean variance optimization, and you're going to run Solver. What will Solver do? It will overweight world equities. So we've just said it's a high-risk asset class. You've now overestimated the expected return. So, of course, Solver is going to run to as much of a corner solution as your constraints allow and take up a large amount of world equities. So it's dangerous to assume, one, that the risk premium in the future will be the same as what it has been in the past, because it does seem to be irrationally high. And two, to take something like the US equity risk premium, which is what has always been calculated in the past, and use that as a representation of the rest of the world, because you'll probably overestimate it there as well. Now, that's really easy to say. The question then becomes, well, if the historical data isn't representative, do you adjust it down? And if so, how do you go about it? I'm not here to give you that answer because it is still being hotly contested, right? Some people are arguing, no, it's high for a reason. There are some risks that we just haven't figured out what they are yet. Other people are saying it's too high, we need to adjust it down. But how do you know how much to adjust it down by? Because how do you know when investors are going to correct the too high equity risk premium? So all I'm going to say now is be aware that it exists. Be aware that if you are using historical returns, Your optimizer may be giving a bigger weight to equities because historically it has been too high, given its risk. And so when it comes to things like your qualitative considerations, you might want to look carefully at your equity weights and wonder whether they should be slightly scaled back if you believe that the equity risk premium will go down in the future. You don't have to do it for your assignment, by the way. Everything I am throwing up are potential things for you guys to think about. There's no one right answer. It's all about going through your own analysis and your own subjective considerations. So that's one thing you could do, right? If you're figuring out what the equity return will be, you might look at what it's been in the past. Another method is that you might instead look at what we call the implied equity risk premium based on current valuations. Now, this is a really neat method because you're not relying on historical data. All you're doing is you're looking at current market value, which you can observe at any point in time. You're taking a risk-free rate proxy. Yes, you've got a few to choose from, but as long as you know your investor and you know their objectives and constraints, it's pretty easy to pick a good one, right? We said if you're a short-term investor, focus on the short-term bills of the amount that will suit your horizon. If you're a longer-term investor, find a treasury bond, ideally with as close as possible time to maturity as what will fit your horizon there. The third part is difficult, and that is that you also need the market expectations on your cash flows. Now, I'm going to come back to why that's problematic in a moment, but first, let's look at the math as to what you'd actually do under this method. You use essentially a big version of the dividend discount model for a share, but you apply it to the market as a whole. So remember, if you've got a dividend discount model with a constant growth rate, current price is equal to next period's expected dividend divided by the cost of your equity capital on the stock, less the growth rate in its dividends in the future. Now, if you apply that at a market level, the current value of the market is equal to the cash flows you expect the market to produce next period, divided by the required rate of return on the market, which you can split up into the risk-free rate plus the equity risk premium, right? Because remember, the equity risk premium is the return on the market less the risk-free rate. So you've got return on the market less the risk-free rate plus the risk-free rate. The two risk-free rates cancel, and you only have the return on the market. And then you subtract the growth rate that the market expects in cash flows. So none of that is based on relying on historical averages or historical modelling. So you can rearrange this to get your expected equity risk premium is the cash flow you expect next period divided by the market value, less the risk-free rate plus the growth rate in cash flows. So it's a really neat method. If you expect cash flows next period divided by the value of the market to be 2%, the risk-free rate to be 3%, and you expect cash flows to grow by 5% in perpetuity, straight away you've got your expected equity risk premium of 4%. The biggest problem in all of this is this cash flow term here. Because unlike equity valuation, where you're trying to figure out whether a stock is undervalued or overvalued, and in that case you can say, well, what do I think the cash flows will be and what do I think the growth rate will be? When you're using this method to figure out the equity risk premium in the market, you're not trying to figure out what the cash flow that you expect is going to be. You need to know the cash flow that the market expects, and you're not the market. Now, there is one sort of natural solution that you might look to, but there's a problem with it. If you're trying to figure out what the market expects cash flows to be, what's one thing that you might look to? Sorry, say again? The index tells you current value. You need the price, you need the current index, that will give you this P. But you're trying to find some way of figuring out what people expect return to be. And there's a particular job that produces particular metrics that you might look to. Analyst forecasts. So you might think, great, let's look at analyst forecasts. It's a better method than just relying on yourself because you can get a consensus forecast, right? You've got lots of different analysts out there. You can take a consensus. But there's a trouble with that, and that is that analyst forecasts tend to be biased. Does anyone know in what direction? Upward, right? They tend to overestimate what value is going to be. So you could look to analyst forecasts to figure out expected cash flows, but they'll probably be too high. You could adjust it down, but how do you know how far to adjust it down, right? This is where your error is going to be. Now, the trouble with that is that if you have a look at the equation, the error in how you model your growth rate in your cash flows is going to exactly be the error in your, well, not exactly, but one of the key sources of error in your equity risk premium, right? So essentially, how good this method is all comes down to how well you can model what expected cash flows from the market is going to be. And if you can't do a particularly good job, then inherently there are benefits to relying on the historical method as well. But then the trouble with the historical method is how far do you adjust it down? There's no perfect way to go about this. People are working all the time on how to get a good way to get the expected equity risk premium for the future. The other issues with the implied method is that it assumes an efficient market, because only then will price actually equal the present value of expected future cash flows, and it ignores the impact of tax and other costs. So the main takeaway in terms of your assignment for this is that when it comes to estimating your expected return on equities, if they are overestimated, which tends to be the case if you look at historical values, it might be, and if you use optimization, your weight might be a bit high. So one of your qualitative considerations is, do I adjust it down? Now, in your assignment, I didn't want you guys to have to model in detail the expected return on every asset class. So I've done it for you based on what your investors, what your clients think they're going to be. It's not a perfect method. Sometimes your clients will give you expectations to use. They are reasonable, but you might again ask yourself, do I think that, am I satisfied with using these? Your clients have given you these expected returns, so use them. Don't ever do something that your clients, don't say, look, you guys are stupid, I think it's going to be like 6%, right? Use it, but if you think it might be a little too high on a particular asset class, and as a result, if you think the optimizer is putting too large a weight on that asset class, if you choose to use optimization, then you can write as part of your qualitative considerations, due to concerns that the expected return on this asset class is high for whatever you have to give for reasons X, Y, and Z, we have chosen to adjust the weight down at the margin, for example. So that's equity market return. Any questions? That's part of the puzzle. I wouldn't call the US market, it is safer than emerging markets, there's no doubt. What it is, though, is it's more transparent. It's harder to get alpha because there's a lot of people investing in it, and it's more efficient. That doesn't necessarily make it safer. For example, with the global financial crisis, the US equity market suffered more than we did because they had more exposures, but it is certainly more efficient. And the reason that we call it the equity risk premium puzzle is that we can't quite explain why the equity risk premium historically has been that high, right? It really does seem to be too high to justify rationally. So the next thing to consider is equity market risk. Now, this is the risk of the overall equity market as a whole. Sorry, my hair's falling out. And if you have a look at the graph, what you can see here is standard deviation per annum from 1880 to 2015, right? So it goes all the way back into the 1800s. Now, can someone tell me what is that massive spike that you can see? It's the Great Depression. And that's why I say one of the reasons I say that the single worst crash that we've seen isn't the GFC. It's the Great Depression, when volatility absolutely exploded. If you include the Great Depression, on average, over the long term, equity market standard deviation has been about 18% per annum. If you remove the Great Depression, which is a good, you have a good reason to do it, and that is that even in the GFC, volatility went up, but nowhere like it used to, right? Markets are more liquid now. There's more information around. It can be volatile, very volatile in the short term, but arguably we're unlikely to see that kind of explosion in volatility again, right? So if you remove the Great Depression, then on average, equity returns have had a standard deviation about this purple spotted line, which is about 15%. Now, one of the things that I want to really draw attention to is, if you ignore the Great Depression, this line looks fairly smooth, right? But remember, we're looking at standard deviation. We're not looking at returns. If these were returns, this would be a very low-risk asset class, but it's not. What we're saying is that volatility has sat in a band between about 10% and 18% per annum over the past century. Now, that's very different to saying that returns are smooth. If returns are smooth, volatility would be close to zero. These are volatile returns. It's just that that volatility has been relatively consistent through time. Now, I've added this bit in the blue, saying that the standard deviation of equity is approximately triple that of fixed income, and I've referred to Excel video number 3. If you have a look, video 3, at the solution file based on current data, what are you doing? Here we go. Let's look at this one. Right, you've got, now this is based on quarterly returns. It's calculated a slightly different way, but as you'd expect to see, Australian equity has been a bit higher risk, but you've seen a band of around 15% for the world, 17% for Australia in equities. Now have a look at fixed income. It's sitting below 5%. Right, so this is, when we say that equity is a high risk, high return growth asset in your portfolio, we mean it. It is 3 times riskier than a broad fixed income index over time. So that's the overall equity market. Now remember what we said in week 2. When you want to understand risk, remember we had those 3 layers. What was the first layer? I don't know if you guys can immediately picture what I'm trying to talk about, but remember how we said you need to look at risk in 3 different dimensions? Does anyone remember what the first dimension was? It's who your investors are. The second dimension? Sorry? It's the market movements. It's what you see on the surface. Remember, it was what lies above, essentially, so your market fluctuations through time, and that's what quantitative measures assess. This is that second dimension. This is what lies above, your surface risks. But remember, what was the third risk? What was the third dimension of looking at risk? Underneath, right? Understanding what lies beneath the market movements that we observe. So to get a gauge of that for equities, it's really important to understand the drivers of the equity market. Now, there's 2 different ways that you can look at this. You can look at this in terms of a fundamental view of how you'd value a stock, or you can look at it as macro influences on the market. If we start with how you'd value a stock, come along. Are you going to work for me? There we go. Think about the stock price. Now, we'll just use a really simplified constant growth rate model of the stock price. Right? Price today is dividend next period over, in fact, let's make this really simple. Let's just call it a preference share. Right? So the price is your present value of your future cash flows divided by your discount rate. So what the fundamental view says is the underlying drivers of equity markets are anything that will drive the numerator or the denominator of this equation, right? The numerator, what drives dividends? Well, they have to be paid out of company profits, right? So anything that will affect company profitability. The denominator is your discount rate. There's a few different drivers, and they include inflation and risk aversion. So if we go back to the slide where I've listed that, It will depend on the market that you're looking at, or if you're looking at an individual stock, it will depend on the stock. But what's going to drive the numerator? Anything that will affect company profits. What's going to drive the denominator? One big one is inflation, and another one is the equity risk premium. Typically, equity markets tend to suffer, and I think I've written this further down. Here we are. Equity markets tend to suffer in times of higher inflation. They also tend to suffer in times of elevated equity risk premiums. Why would an equity risk premium suddenly jump up? Yeah, essentially it means that the markets have become riskier, they have become more potentially damaging, so risk aversion tends to climb. So what you tend to see with a bear market is a combination of both of these factors. First of all, the economy starts to decline, so company profits start to fall, so the ability to pay dividends from those profits start to fall, and the numerator of the equation goes down. And because the economy is in a negative period, because we're in things are starting to become worse, because unemployment is rising, what tends to happen is that people start to get scared at how bad it's going to be. So equity risk premiums tend to go up. That's going to cause a rise in the denominator, which is further going to bring down equity market values. Right? So to get those major bear markets, it's typically because the numerator is dropping and the denominator is rising. So you've got a double hit for the overall valuation of equities. If you're looking at the overall equity market, though, it actually helps to start to think about it in this second way, which is to look at the macroeconomic influences for the equity market. Now, one of the biggest and most obvious ones is the economy. I mean, you'd be really hard-pressed to find a time when the economy is suffering, but the overall equity market's doing well. But there is a problem with using the economy to help you to predict the equity market, because that actually works in reverse in reality. And we spoke about it either last week or the week before. The stock market is actually what we call a leading economic indicator. And can anyone remember why the stock market tends to go down before the economy?
Because the stock price reflects like the investor overlook of the cash flow.
Yeah, it's the outlook in the future, right? So it's what you expect future cash flows to be, right? So if the economy is starting to weaken, that means that investors now will discount future cash flows. They'll start to think that future cash flows will be lower, which causes current equity value to drop before the cash flows have had a chance to actually go down, right? Because it's all about the expectation. So what tends to happen is that the stock market tends to drop before the economy goes properly into a negative period, a recession. Another one, which we looked at in the fundamental risk approach, is the profit share. Now, luckily, this hasn't happened for several decades, but it did happen back in the 70s, and it's one of the key reasons behind the bear markets of the 70s. What happened back then is that the profit share got really squeezed out because the wage share expanded. Right? So if the economy, remember, is the same, if the income being produced by the economy is constant, and therefore your revenue as a company is the same, but you now have to pay out more expenses because you need to pay your workers more. You've got your revenue, you're paying more expenses, which leave less available as profit, and that's going to shrink the profit share, which is obviously going to shrink the amount of dividends you can pay and the returns available for investors. Okay, so the key there is that the revenue of your company is the same. Your expenses are increasing, so your profit is going down. Another one is inflation. Remember we said, I think last week, that inflation tends to be good for real assets, but bad for financial assets. What you tend to see is when inflation goes up, the required rate of return on equities goes up, which brings down valuations. So if you expect inflation to go up in the future, that is a negative signal. There's many signals you need to combine, but that is one that is a negative signal for equities. Ultimately, what you'd be looking at is for a number of these different signals to be signalling a recession, for example. If a lot of these different things are starting to ring bells for a recession, then you start to get bearish on your equities. So you're combining the different influences together. Another one is resource or capacity utilisation. Now, I don't expect you guys to understand the details behind it, but think of it as a way of think of it as how well is the capital available being used in the production of goods. Is production high? Is unemployment low? Or is it the reverse? Now, when capacity utilisation is low, the business cycle tends to be in a recession. When capacity utilisation is high, business cycles tends to be in an expansion. And to show you just how strong that relationship is, have a look here. The grey shaded bars are NBER recession, and you can see that in these periods, your capacity utilisation is dropping quick. And it's when it turns around that you move out of your recessionary periods. So that gives you a flag to look for. What is the production in the economy like? What is unemployment? I don't expect you guys to model this in detail now. It would be a course in itself, but I just want you to be aware of the type of flags that you might be considering if your job is to look at this in the markets. You might also look at things like monetary policy and general liquidity that is related to policy as well. Let's say that the economy has been fairly low, and the central bank wants to follow what we call expansionary monetary policy. In other words, they want to do things that try to kickstart the economy back up out of a recession. One of the first things they tend to do is drop interest rates. Right? By dropping interest rates, what does that mean in terms of borrowing? It's cheaper to do. It's easier to borrow, right? People think, I can afford to borrow, so they start borrowing. If they start borrowing, they have money available to start investing. You start investing and you start to kickstart the economy again. The economy starts to go up. And eventually what will happen is after a while, you've got the money supply is stronger now, there's more liquidity, people have more money to spend, there's a limit to capacity, to supply. So people are spending now, they're investing. And if there's a limit to the supply available, what tends to happen is inflation will start to kick in. Now, when inflation gets too high, the central bank will move into what we call a contractionary policy. What will they do with interest rates then? They'll increase them. They tend to increase interest rates. That will limit the money available, the liquidity available in the economy. It will make it harder to borrow. And that will slowly bring markets back down and potentially keep them going down until you hit a bear market again. So it's one of the things that will, they attempt to correct the cycles, but then eventually you'll move into the other part, the other extreme. So if you think about, let's say inflation is high, we already know that that isn't great for equity markets. Now the government moves into a contractionary monetary policy to try to fight high inflation. So they increase interest rates as well. That's going to give another push up to the discount rate on your equities, which is going to bring your equity values down. And if interest rates are high and it's harder or more expensive to borrow, people have less to spend on investment, which is potentially going to hurt company profits too. So you can see that with a contractionary monetary policy, which does happen for the right reason because inflation is getting too high, it can actually increase the probability of moving into an equity bear market. And another big one to look at is buying and selling power. Now, there's a wonderful quote by Baron Rothschild, and that is that you should buy when there's blood in the streets. He meant this in a way, figuratively, but only because he created a rumour that didn't come to pass. Anyone that has ever had me in any other class probably will have heard me say this because it's one of my favourite stories of all time. But forgive me if you've said it because I'm going to repeat it. Does anyone not know what happened with Baron Rothschild and the Battle of Waterloo? And yes, I'm asking you guys to put up your hands. Can I tell this story? Has anyone not heard it? Yeah, good enough? Great, I get to tell my story. Okay, so this is back in the 1800s. There was a Battle of Waterloo. It's a very famous battle. And the Brits in England were terrified that the French, led by Napoleon, would win the Battle of Waterloo and they would lose. So, the Battle of Waterloo is going on. And somewhere amongst this battle is a messenger on a horse. When the battle is lost or won, this is an English messenger, someone will tell them the news. They will get on their horse, they will gallop for days sometimes to the next guy waiting on another horse, they will pass the news on, the next guy will continue. And it takes a while to get back and roll into London. Baron Rothschild was already very wealthy investor, and he had a flock of carrier pigeons that were trained to bring him news. Now think about how fast a pigeon can fly through the air as the crow flies, compared to how fast a poor little guy on a horse can gallop across the countryside. And there's no as the crow flies here, you need to use the windy roads. So which is going to get there first, the flock of carrier pigeons or the poor last final guy riding in exhausted on his horse? The pigeons, right? So, the Battle of Waterloo occurred, and it turns out the Brits won. News goes to the carrier pigeon, gets to Baron Rothschild ahead of the rest of the country. Baron Rothschild now has information that no one else has. So what do you think he tells people? He did. He told everybody that they lost the Battle of Waterloo. The Brits were devastated, terrified, and started selling all of their assets, right, at fire sale prices, right? Because what do we have? We had a flood of supply and very little demand, so prices are going down. Guess who's buying the assets? Baron Rothschild at lower prices. And then all he needs to do is he's bought assets at very deflated prices. He gets to sit back, have a cup of tea and wait for that poor guy to roll in on his horse. The guy gets there, the Brits find out they'd won. Okay, they've heard a rumour that they lost. Thank God we won. They were so excited. They were elated. They didn't think, hang on, someone's misled us. They went, oh my God, Britain has won. We still, we're not going to be taken over by the French. So what did they start doing? They started buying the assets back. And they had higher demand, and that pushed the values back up. And guess who was selling them the assets at high prices? Baron Rothschild. It's said that he increased his fortune 20 times over, was what I read, just through that process. Right? So this is all about fund flows and positions. If everyone is selling and prices are going down, then you're in a position, if you can, to buy everything back at low prices. That's when there's metaphorical blood in the streets. Not actually because they won, or blood for the French, I suppose, but what you want to do is you want to buy when everyone else is selling, because that's when values are low. And you want to sell when everyone's euphoric and buying. And that actually relates back to this second argument of risk aversion. When everyone is selling, it tends to be because they're quite risk averse, so they don't want the risky equities, so they sell them off. And that means that prices tend to go down. So with high risk aversion, you've got a higher discount rate, plus the laws of supply and demand, because people tend to sell, causing equity values to be low. If you can buy them while they're low, then you're in a position to wait till they come back up, and you can sell them at higher prices. And the last one is to just look at valuations of equities, both absolute in terms of are equities over or undervalued relative to what they've been in the past, and relative to other asset classes as well. And if you've got a number of these different things that are signalling an equity bull market in the future, then you might want to start increasing your equity weight. And if a number of these things are indicating an equity decline, you might want to tilt your weight away from equities, reduce the weight. Not necessarily get rid of it altogether, because remember, you want a broad, diversified portfolio. But at the margin, it will be indicating a drop in your equity weights. Any questions on that? All right, now my trusty little, since I felt really guilty because the past few weeks I have actually made you guys sit there for an hour and a half, my clock went off to tell me that it's been an hour and I need to give you guys a break. So it's 3:03, let's come back in 5 minutes and we'll keep going with the lecture. All right, so if we keep going about the type of things you might want to consider when you're looking at an equity investment, The slides might help. The next one is taxes. Now, I'm not going to ask you to do a numerical tax question like what you see here in the exam. The reason is, as I understand it, not everybody has done a dividend imputation system. Even if I'm wrong, don't tell me I'm wrong, because I've just told you I won't ask you this numerically in the exam. But what I do want, even if you haven't done the ins and outs of an imputation system, I wanted to show you an example so you could understand conceptually how important it can be for an Australian investor. So for those of you that haven't done imputation, there is two types of tax systems. One is the classical tax system. That is the case, for example, in the US, as well as many other countries. In a classical tax system, a company earns revenue, pays expenses, the rest is pre-tax profit. They then pay tax on their profit, and what's left, out of what's left, they pay dividends to investors who pay tax on their dividends. In other words, a dividend is taxed twice, first at the company level as profits, second at the investor level for the tax on the dividend. Then there's an imputation system, right? Australia is one, the UK, Canada. Now, an imputation system can remove the effect of double taxation as long as the dividends are what we call franked. Now, what happens in a dividend imputation system is the company operates as normal. They get revenue, they pay expenses, what's left is pre-tax profit, they pay tax on that, and what's left can be paid out as dividends. But they pay that, if they're paying out what we call a franked dividend, they've actually paid the tax on behalf of the investor. Now, the company tax rate in Australia for most companies is 30%, which means when you get the dividend, about 30% of the tax has been paid on your behalf, so you only need to pay the additional difference to make up your marginal tax rate. Or if your marginal tax rate is less than 30%, as is the case we'll see with the super fund, you actually get a bit of tax credit back for the difference, and you can offset that tax credit against your other taxable incomes. Again, I don't expect you to know the details for calculation purposes, but I do want you to see what a big influence it can have. Because what we have here is the exact same stock, which can be purchased by two potential investors. Right? So remember, when you're looking at whether equities in general is a good investment for you, one of the things you need to ask is, am I an Australian investor? Because if you're an Australian investor buying an Australian equity index, you can take advantage of any franking, right, which reduces the tax you pay. Whereas any other country that you purchase equities from, you don't get that advantage, which is a big benefit to investing in Australian equities. But even within that, within Australian investors, because we have different marginal tax brackets, how attractive it's going to be on a return perspective can be really, really different. And remember, this is the exact same stock, so the risk is the same, right? The pre-tax return is identical and the risk is identical. What differs is the after-tax return, and it differs in a major way. So I showed you this briefly in an earlier week. I want to go through the mechanics now. I put everything in percentage terms. So you're investing in, let's just call it a stock, but it could be the equity index. The stock is going to pay a 5% dividend, and you're going to then sell it to realise a 5% capital gain. Let's start by assuming that we are not the private investor. We are not the super fund. We are the private investor. So we get a 5% return based on dividends, a 5% return from capital gains, which means our pre-tax return from the stock is 10%. Now, let's go into taxes. We'll start with the 5% dividend. That dividend has had attached to it what we call imputation credits, which are 80% franked. You don't need to know the calculation, but the way you do it is you essentially back out the fact that you have a 30% tax rate. 3/7 is the 30% company tax rate divided by the 70% remaining, so 100 minus your 30%, times by 80, which is the percentage of franking credits. Again, you don't need to know the specifics of that, but for anyone that has done dividend imputation, that will make perfect sense. But the fact, what I want you guys to know for this course is that when you receive that 5% dividend, 1.7% of the tax on that dividend has already been paid for you. So the first thing you do is you calculate what we call the grossed up dividend. In other words, if the company hadn't paid the tax on my behalf, if I'd received both the 5% dividend and the tax and the amount that the company has already paid tax on my behalf. So in other words, don't pay the 1.7% for me, give it to me instead. What you would have got is 6.7%. That's your grossed up dividend. Had you received the full 6.7%, we're going to assume that you're in the top tax bracket. So you receive 6.7%, you pay tax at a rate of 45% on that. So 45% of 6.7% means that your tax liability is that you're going to lose 3% of the grossed up dividend had you received 6.7%. But remember, you didn't receive 6.7%, you received a 5% dividend, and 1.7 had been paid on your behalf by the company, which means what you owed would have been 3%, but they've already paid 1.7 for you. So you only need to pay the difference. The only tax you need to pay is 1.3, right? Because 1.3 that you pay plus the 1.7 the company paid for you is the overall tax liability. So you receive a 5% dividend income, you pay 1.3 of that in tax, and you're left with the difference. Now, let's move on to, I'll come back to the super fund, let's move on to the capital gains tax. If you have, I call the capital gains tax 22.5%, not 45. Why would I have changed that to 22.5%? What am I assuming? I've held it for more than a year. Because remember, if you hold an investment for more than a year, you have a 50% discount on the capital gain tax that you have to pay, which is a very big advantage. You never want to sell a stock if you can possibly help it. Don't sell it if you've held it for 11 and a half months, right? Wait the 2 extra weeks because that's going to really decrease your tax, which of course leaves more in your pocket. So you are going to realise a capital gain that will give you a return of 5% before any tax. Capital gains don't have imputation credits, right? That's just the dividend. So you get a return from the capital gain of 5%. You have to pay tax at a rate of 22.5%, which means you need to pay 1.1 of the 5 in tax. So the total tax you need to pay out of this 10% return is 1.3 on dividends and 1.1 on capital gains. That's 2.4 overall. So of your 10% return, you lose 2.4, which gives you a 7.6% return net of tax. So you can see that is a big drop in the return that you get versus the return that the company produced. Now let's assume that we're the super fund. The first thing to realise with a super fund is that they pay tax on regular income, so dividends, at only 15%, and they pay tax on capital gains at only 10%. So a much lower tax bracket, particularly if you compare it to an investor in the top income bracket that has a marginal tax rate of 45%. So the super fund gets the same return. They get 5% from dividend and 5% from capital gain, so 10 overall. If you go to the dividends, remember the company gave them a 5% dividend, and they've also already paid 1.7 in tax on their behalf. So that gave them the grossed up dividend of 6.7%. But the super fund only has a dividend tax rate of 15%. So they should have only paid 1. Turns out the company paid 1.7. They should have only paid 1. So what they get is they get the 5% dividend return and a 0.7% tax credit. They get a little bit of the tax back that the company paid on their behalf because the company overpaid based on the super fund's tax bracket. So they actually have a post-tax dividend income higher than the pre-tax. Then they get, remember, if we go to capital gains, they get the 5% capital gain, they pay tax on that at a rate of 10%, so they pay 0.5 in tax. To get the total tax they pay, well, they get a tax credit of 0.7, they have to pay 0.5, which means their overall tax is actually a credit they get tax back of 0.2%. Again, don't stress if you haven't done imputation. But the fact is, you've got a private investor paying 2.4 of the 10% return in tax. You've got a super fund not only getting their 10% return, but also getting a tax credit, getting an extra return of 0.2%. So the super fund is better after tax, and the private investor is considerably worse. Now think about this investment on a risk-return perspective. The risk is the same. It's the exact same stock. The return is very, very different because of taxes. Okay, so the attractiveness of equity, if you look at super fund equity allocations, they are arguably still higher than they should be. They are coming down over time. But a super fund can afford to take on a higher equity weight in terms of how attractive it is on a risk-return basis than an ordinary investor with a big tax bracket. Okay, so there are benefits to some investors that are more extreme than for others. All investors in Australia benefit from franking, but the benefit is a lot better when your tax rate is lower. Does the concept make sense? Is there any questions on the overall concept of why it really matters what tax bracket that you're in? Okay, yeah. It does. Now, there are in fact some endowments and charities, and speaking of what we said earlier today, the ANU Student Managed Fund actually is a tax-exempt investor. They pay no tax. So every single dollar of franking credit, so every single dollar of tax paid on their behalf, they get back as a credit. Charities are often exempt from tax. So yeah, in some cases it's even more extreme than the case that you see here. So it's really, when you remember, it's all, your first question is, who is my investor? What are their circumstances, objectives and constraints? One of the big things you need to ask is, what is their tax situation? You don't need to do that for the assignment, by the way, because we have two private investors with massive incomes. You can assume they're in the highest tax bracket, but I don't expect you to calculate tax numerically in the assignment. That will go into a lot of legal issues that I don't expect you to learn for the course. But if you're looking at two investors in different tax positions, then the relative attractiveness of equity might be very different. Okay, so we've looked at risk. Earlier we looked at risk of equity overall. Now let's have a look at risk and return within equity portfolios. And what this comes down to is that an end investor shouldn't ever have a portfolio that is really concentrated in a particular type of risk. Now that doesn't mean that every manager should have a broad, well-diversified portfolio, and I'm going to come to investment style in a moment. But when you look at your portfolio, it's really valuable to look at the different risk exposures and concentrations. Think about the fundamental risk approach. What you want to do is look at what your holdings are and say, do I have a big concentrated risk exposure that could hurt me and that I could diversify away? So one of the big ways, and I'll talk about tracking error first, but one of the big ways that you look at how much risk is in your portfolio is by looking for common factors between your portfolio holdings. But before I go to that, let's start with a big risk measure that you guys have used already, and that's tracking error. Now, in equities, tracking error is not assessed relative to a peer group like it is in a multi-asset class space. It's typically looked at with respect to your benchmark. So if you look at your historical tracking error and you're an equity fund, you take your own returns, you subtract the returns of your benchmark, and you take a standard deviation of that difference. So one of the things that equity managers will be evaluated on is how big is their tracking error. Another thing that they will therefore look at when they look at their strategy for the future is, given a strategy, how big do I expect my tracking error to be? Right? Because if you're looking at two different strategies and you have a tracking error mandate where you can have a tracking error of no more than 2%, one strategy might be very profitable, but if you expect it to give you a tracking error of 3.5%, it's not an option to you, right? So it's really important when you take on a strategy to say, am I constrained to operate within a particular tracking error? And if so, your positions can't be too extreme away from the benchmark index that you're evaluated against. Now that said, there is a problem with being active and having a very low tracking error. Can anyone think about what that is? If you're a passive fund, what would your tracking error be? Zero, pretty much, right? In the active space, we have something that we call closet indexes. Now, closet indexes are funds that call themselves active. They therefore charge really high fees because they're active. But when you look at their tracking error, it's basically zero, right? So in other words, they are charging you money so that they can hold a portfolio of stocks that pretty much behaves like the benchmark. And you could have just invested in a passive fund instead. So don't assume that bigger tracking error is necessarily bad, right? It is a form of risk, but if you're an active investor, you need some tracking error, or you're just essentially charging investors money for something you're not doing, and that's differentiating yourself from from the benchmark. But once you get into positive tracking errors, the higher it gets, you need to be aware that this is going to be a much more concentrated portfolio than the passive benchmark, and so there may be risk exposures within that you should be aware of. Now, talking about risk exposures, one of the ways you might look at a risk exposure within an equity portfolio is by calculating its beta through a time series regression. So that might be the beta on the market factor, it might be the beta on the size or value factors of the Farmer-French model. All of the type of betas that you've looked at in investments, you might look at when you're trying to gauge the risk of a particular equity portfolio. If there is a large beta on the size factor, it might indicate that the fund has a large position in stocks with a small market capitalisation through the Farmer-French model. More broadly, when you look at common factors, you might have the Carhart four-factor model. Now, the reason I have included Carhart four-factor model under a common factor, not under a beta, is remember that issue with the definition. Farmer-French and CAPM factors fit in both industry and theoretical definitions of beta, but momentum fits the industry definition of beta, but not the theoretical definition. So for safety, I've just called it a common factor. It doesn't really matter for the purpose of your exam, the fact that I've put it as common factors, but what does matter for your exam, because we looked at it in week 5, is that there are some factors like momentum that fit the industry definition of a beta because you can replicate it for low cost, but not the theoretical definition of a beta because it isn't actually based on non-diversifiable risk. So you might look at things like your Carhart four-factor model. You might want to look at whether all of the stocks in your portfolio are based on a similar investment style. I'm going to come back to investment style in a moment, but it might be that they're all small caps, it might be that they're all value stocks, or they might all be growth stocks, for example. You might want to look at whether you've got a high concentration in your portfolio of stocks within a particular industry. So, for example, if your stocks are all based in construction, you might be particularly sensitive to changes in interest rates, so that would be important to be aware of. You might look at things like proprietary factor models like Barra and Northfield. I'll show you an example of Barra in the next slide. I don't expect you guys to know these because they are proprietary, right? Companies spend a lot of time developing them, but they do spend a lot of time and invest a lot of money into trying to get factors that will help them to monitor their risk exposures. And you might consider stock-specific risk. I've included it for completeness, but really also just to say that you should be diversifying most of your idiosyncratic risk away. If you have if you have a marginally well-diversified portfolio, the stock-specific risk should be quite low. Now, when you're looking at risk factors, concentrated risk exposures within your equity portfolio, I want to give you an example of this proprietary factor model that Barra uses. It's a terrible, so I can't get the cut and paste to be better, but it is in your supplementary readings, where it actually is easier to read. But what these models try to do is essentially figure out macroeconomic variables. They try to find microeconomic variables to help explain your macroeconomic sensitivities and your return and risk. So in other words, what microeconomic factors of a stock will help us to understand how that stock is going to react to macroeconomic events. Because remember, we've said that one of the key drivers of equity is its exposure to macroeconomic factors. So what Barra does is they have a whole range of different, and by the way, I've said the details of what these factors are not examinable. This is an example. But they've got a whole bunch of different value metrics, growth metrics, earnings variation metrics, leverage, and foreign sensitivity metrics. So for each stock, They use, as you can see, some are historical and some are forward-looking measures, some are market-based, some are accounting-based measures, and for each stock they try to figure out what is its exposure to the value factor, what is its position in terms of earnings variation. So if we take those two, for example, you might want to know how many of your stocks have a high value rating, because value stocks typically have a low market price relative to their book value. So you might see them as being out of favour with the market, which could make them particularly vulnerable to economic downturns. Earnings variation. If you have a lot of your stocks in your portfolio have very high earnings variation, then it might make it harder to actually, for that stock to meet its expenses or debt obligations in particular years. If that is too extreme, it could increase the risk of bankruptcy for those stocks. Right? So these are all things that essentially you're using to say, can I find indicators that will tell me whether my stock might be very vulnerable to a particular macroeconomic event? I've set up here for macroeconomic fundamentals, I've given examples of industry size and leverage. Now, the industry example, I remember if all of your stocks are related to construction, you might be particularly exposed to changes in interest rates. Look at size. If your stocks are all quite small, will small caps find it harder to secure funding at the best of times? If we stick with the interest rate example, it tends to be more expensive to borrow, and it tends to be harder to borrow when credit markets are going to dry up in times of global financial crisis. Right? So if you think about the GFC, you're a small company, your business is down, you need to borrow. If you can, it's more expensive, and it's also a lot harder to do. And that could put you in a very difficult position financially. And obviously, the more leveraged you are, it amplifies your highs and your lows. So if you have a high amount of leverage, when the market is down, you're not getting a lot of profits, you've got a lot of interest expense because you're highly levered, you're struggling to pay that off, your interest rates, if they're variable, might be going up, certainly refinancing rates are going up, it's more expensive to continue to borrow, and you end up being at risk of collapse. So you're trying to use these fundamentals to find vulnerabilities in the stocks, and if you have all of your stocks with similar vulnerabilities, that's a massive fundamental risk for your portfolio. So that's looking at the stock level. The next thing to do is to say, well, if I'm multi-manager investing, am I picking managers that themselves only invest in stocks that are going to have particular exposures? And it's fine if they do, as long as I'm spreading my investment between the different styles. Now, we're going to look at this a lot more in Lecture 11, but it's really common of big superannuation portfolios. They'll have an equity bucket, and they'll allocate some money to Australia, some money to world, some money to emerging markets. Within Australia, they might invest the money themselves, or they might take that money and give some money to an Australian small cap manager, some to an Australian large cap manager, some to an Australian value, and some to an Australian growth manager. In other words, they take the money, they outsource it to different managers, and those managers invest in the end assets. They're the ones that actually pick the stocks. So if you're going to have a multi-manager investment portfolio, you're not picking the end stocks. So you're not the one doing stock diversification. So you just need to ensure that you're diversifying amongst the different manager styles. So a style is all about how a manager approaches investments. It might be that they only focus on stocks with a particular market capitalization, maybe small caps, maybe large blue chips. It might be that they focus on stocks that have a high value score, or they might focus on stocks with a high growth score. So in other words, they might become specialists at picking outperforming stocks in a very specific area. The idea being the more they know, the more specialist knowledge they have in that particular area, the better they're going to be at picking those types of stocks. But if you're a value manager that always focuses on the value factor and what will make a potentially good value stock, you might not be equipped to suddenly go out and buy a good growth stock. You might also be market-oriented or have a sort of breadth strategy where you're looking at many different things at once. But you'll find that a lot of managers, particularly in the US, focus on just one type. So if you do have managers that focus on just one type, you want to make sure that all of your managers aren't focusing on the same thing, right? You don't want to give all of your money to a bunch of different good value managers, because then you're going to have a high concentration in the value factor. So when you pick your managers, you want to check they're not too similar. What might you look at? You might look at things like return correlations, right? If all your managers are following a growth strategy, their correlations in their returns are likely to be quite high. You might look at the portfolio characteristics. So you've got your managers, look at the stocks they invest in, and are those stocks all growth in nature, or are they all small caps, right? You want to make sure that the different managers have stocks with different characteristics. You might run regressions to figure out your factor exposures, like Farmer French. And you might look at their philosophy and process. We're going to look at philosophy and process in the last week. But if all of your managers explain how they pick their stocks, and it turns out that they follow a very similar process, chances are their portfolios are going to look very similar as well. Right, so it's exactly the same as a stock diversification argument. Don't put all of your eggs in one basket. Except if you're allocating your money to your managers, you just want to make sure that you're giving your money to different types of managers rather than investing in different types of stocks. Does that make sense to everybody? Cool. Now, in the US, it's really easy to do this because typically funds will market based on their style, right? A growth fund tends to have growth in its name, and it tends to be benchmarked to a growth index like the Russell 3000 Growth, right? So all you really need to do there is just check that if a manager's calling themselves growth, they're investing in stocks that do look like growth stocks, but it's a much quicker process. In Australia, style is less distinct, and that's because more of the Australian market is actually benchmarked to a broad Australian index rather than a style index. So because of that, you tend to gravitate a bit towards your benchmark. So if you're picking Australian managers, you might need to look a bit closer into these different ways to detect similarities between the different managers that you invest in to make sure that they're not all doing the same thing. Yeah. Look, you can have a fund domiciled in Australia that is either global in its scope or US focused. It's typically, there's not a lot of Australian funds that are focused on purely the US just because it's a lot easier to do it from the US, right? But you can absolutely have a fund that's domiciled in Australia that invests overseas. Easy, right? So individual investors can absolutely buy shares, from overseas exchanges, but it can actually, an individual investor can buy on the Australian Stock Exchange an overseas fund nowadays, so BlackRock has a series of iShares, and if you invest there, BlackRock have iShares that are ETFs that track a global index. So you can trade on the Australian Stock Exchange, but actually be picking up a global ETF. So it's much easier now than it used to be to get an overseas exposure. So when I say in Australia, that's a good point. When I say in Australia style is less distinct, I mean Australia-focused funds. So another thing to do is to look at the different subclasses of equity. And if you want a well-diversified portfolio, as you guys are doing in your asset allocation, you're going to be looking at a number of different subclasses, right? You don't just have an equity line. You have an Australian equity, world equities unhedged, world equities hedged, and emerging markets, for example. We focus on the first two and the fourth in the list, in that we tend to look at domestic, overseas, and emerging market equities. But I want to go through a number of different ways they can be broken up. Domestic equities, as we're going to talk about in week 10, has a massive couple of advantages. One is that they're familiar to us, and Aussies tend to be quite country proud. You've got those Australian-made, Australian-owned stickers. It's not uncommon for someone to go, I want to support Australian companies, they're fair dinkum, It's a very Aussie mentality. And if you have a look in your assignment, you have, I think it was Robert that said, look, I actually still want a big chunk of my investments focused on Australia, and that's not unusual. So they're familiar, they're easy to access, but they are a limited subset of the overall investable universe. What are our two big industries in Australia? Banking and mining resources, right? So if you're investing in an Australian index, you suddenly, and only Australia, you've got two big exposures in terms of your industries. You've got a huge amount in banking and a huge amount in resources. But if you want to get a really good exposure to the best techs of the tech stocks, you know, if you want Apple or Microsoft or Google, if you want consumer stocks like Nike or Macy's, you have to look overseas. Overseas equities, therefore, do give you that diversification potential that is better than just focusing on Australia. But the second you invest overseas, you have the issue of, do I hedge my currency risk? We're going to look at that in week 10. And it can be harder to access. If you want a diversified world equity ETF, that's really easy now because of things like BlackRock iShares. If you want a specialist overseas equity manager, they might not even market or distribute their fund to Australian investors. We're like a tiny proportion of the market. So it's not always easy to get access to particular overseas investments, but if what you want is a broad, passive, diversified exposure, then it's very easy. There's also, you can choose that you might want to invest in large caps, mid caps, or small caps. And here you've got a trade-off between liquidity and capacity and inefficiency. Of those three, which are the most liquid and therefore have the greatest capacity? I'll come back to capacity in a tick. Large caps. Which are the most inefficient? Small caps. And why is inefficiency potentially a good thing? Alpha, right? If you're an active manager trying to find undervalued stocks, well, they're only undervalued if the market is inefficient. Because if the market is efficient, then all stocks are priced at their fundamental value, right? So alpha can't exist in a perfectly efficient market. You need inefficiencies there. And typically small caps are less efficient or more inefficient, which makes it easier to generate alpha. Capacity relates to price impact. If a strategy has a high capacity, then you can invest a lot of money in the stock before you shift the price. If a strategy has low capacity, then when you start putting money into an investment strategy, very quickly you will move the price. Okay, so it's related to liquidity, essentially. High capacity means high liquidity, low capacity means low liquidity. You might want to invest in emerging markets. Now, a benefit, and we're going to go into this more in a moment, is that they're high return. A cost is that they're high risk. And there is this issue of beta, and I'm going to talk about that in a couple of slides. Beta, particularly if you're investing in USD, is quite high now for emerging markets, which limits its diversification potential, but it has come down recently. I'll come back to beta over the next two slides. Downsides of emerging markets, they are less liquid, they have lower capacity, and they are harder to access. And that is even more so for your frontier markets, which are further out along the spectrum in every sense. They're higher return, they're higher risk, less liquid, lower capacity, and harder to access. Right, so your typical emerging markets, China, Thailand, Brazil, they have all of these issues, but they're becoming more established, so it's not as risky as your frontier markets. But one of the nice things that's discussed in your supplementary readings is that emerging market returns are becoming a little bit less correlated over the last year or so, which means there is good diversification potential even within emerging markets. And then it turns out that the correlation between emerging markets and world markets over the last year and a half is lower as well, which means that emerging markets are becoming better diversifiers again. But I'll talk about that soon. There are specialist funds that have targeted exposures in a particular specialty. That might be a particular sector, a particular country, a particular region, a particular strategy. Now, if this is the case, what you tend to have is highly specialised management that have expertise in that one area. That is their mandate, that is all they do. So the breadth of their bets is constrained, right? If you are an Argentinian frontier emerging market equity manager, you can only invest in Argentinian equities. You can't go and buy a bunch of Aussie small caps. Okay, so they're a very limited subset of the universe, but they are specialists in the area. So the idea, it's not always the case, but the idea is this is what they do, this is what they're skilled at, and therefore they will do well in that space. So it would be very hard for us to go, or most of us, I'm guessing, to go and know which Argentinian small cap stocks to buy in that market. But there will be a specialist manager out there, and that is all they do for a living. And you might have a global tactical asset allocation fund. We talk about this a bit more with hedge funds because it's where they tend to sit. They're really hard to define because essentially what they do is whatever is hot right now, right? So they will time whatever sectors, countries or currencies are good at that particular moment, and it's always going to be changing, right? So they essentially can do whatever they want, and they're going to pick the hot markets at any given point. Tends to be hedge funds. Now, I wanted to talk a bit more about emerging markets, and you'll talk about it more in a future tutorial, and you have an examinable reading on it as well. But the examinable reading was written a few years ago, and so I wanted to talk a little bit about what's happened since. It's such a good reading that there isn't an updated, so that reading is the best emerging markets reading I can give you to get a full understanding of it. But the data there, I think, finishes in 2013, so I want to expand it out to talk about what's happened. This data ends 1 week. No, what date are we? This data is up until about 3 weeks ago. So that way you can really see what's happened in the last 2 years. So have a look. This is 3-year rolling returns for emerging markets, Australia and world equities. The first thing you can see is that emerging markets have high returns and they're highly volatile. And at least up until the early 2000s, they also had low correlation with with world equity markets, which meant, think about the CAPM argument or the diversification argument. Yes, they're high return. Yes, they're high risk on their own. But because they're a good diversifying asset, some of that emerging market risk can be taken away when you include it in a multi-asset class portfolio. So up until the early 2000s, they were a really valuable diversifier with the additional benefit of being, on average, high return. Although you can see they have big periods of drawdowns too. Trouble is, when you moved into the 2000s, the correlation between emerging markets and world equity markets went up quite a lot. So its ability to diversify went down. So now you've got a high risk, high return asset class, but it's not a very good diversifier, so it's hard to get rid of that high risk aspect of it. Emerging markets are still valuable, but less so than they would have been had they been a very good diversifier because they have low correlation with world equity markets. The reason that is so important, and you've got it in one of your supplementary readings, but you can see it particularly in the next slide, but you can see it a bit here as well, is in the last year and a half in particular, the correlation between emerging market equities and world equities is starting to go down again. The two are becoming uncoupled, which means if it continues, emerging markets might again become that very good diversifying asset of your developed market equities. So essentially what I want to say for emerging markets is watch this space. Their diversification potential may again increase in the future. But even now, if you're an Australian investor, emerging markets are actually still a very good diversifier, even though if you were a US investor, they weren't for a long time. In other words, it really is nice to be sitting trading in Australian dollars. What you can see in the orange is the beta of emerging markets against world markets when returns are measured in US dollars. What you can see in the blue is that same beta, but when returns are expressed in Australian dollars. What you can see, let's go back to the orange. If you look at the 2000s, beta is high, and it's staying fairly high right through that decade. It is now starting to come down a bit, which reflects the fact that emerging market diversification potential is increasing. But if you look at Australian dollars, the beta, which did spike at about 2000, has come steadily down ever since, and it's now right down at 0.4. And the reason is that what tends to happen is that there's a positive correlation between the Australian dollar and emerging market returns that acts as a diversifier within itself. When emerging market returns are high, the Aussie dollar tends to be high as well. So when you take your emerging market return and convert it into Australian dollars, you're getting a bit less, which brings that high return down a bit. But when returns on emerging markets are down, the Aussie dollar is down, which means you get to take your bad emerging market return and convert it into more Australian dollars, which takes the edge off your downside risk. We're going to talk about this a lot in week 10, but what it means is returns are smoother if you're an Australian investor investing in emerging markets than if you're an overseas investor. And if you have a look, here you can see that as you shorten the sample period in this table towards today, in general beta is dropping from 03 to 13, but it's really low if you're an Australian investor versus if you're a US investor. So for us, emerging markets are a much better diversifier. Any questions on that? We're going to talk a lot about the correlation between the Aussie dollar and other equity markets in week 10. But remember, it's not just about what the return is in your overseas currency, it's about what your return is once you convert it back to Australian dollars. Now, what I wanted to finish with is you've got a few different ways to access your equity markets. The first, if you talk about ways of investing in the top left, you could just buy shares directly, right? You could trade on your CommSec account, very easy to do. You could choose to invest through an investment manager. They could be closed-end or open-end. Now, it's really simple. If it's a closed-end manager, it will bring in money from the investors at the start, and once it has a certain amount of money, it will close to new investors and list on the exchange, and the number of shares in that fund won't change. So if you're in a closed-end fund, if you want to get out of it, you need to sell your shares in that fund to someone else. If you want to invest in a closed-end fund, you need to buy those shares off someone that is currently in the fund. So think about a closed-end fund as a publicly listed share that isn't raising any new equity, isn't giving any new equity offerings. An open-ended fund will take in money from investors at any time and give money back to investors at any time. So if I want my money back and I'm in an open-end fund, I can go and ask the manager to give me my money back, to redeem my shares. And if I want to invest in an open-ended fund, I can go and purchase shares at any point. The fund will create more for me. You could invest through fund of funds, right? That's multi-manager investing. So you give your money to a fund of fund, and they then invest that money in different funds that go and invest in the end assets. That's really big in private equity and hedge funds. It does exist to some extent in public equity as well. Now, a big benefit of that is when it's hard to pick a good manager, you're giving your money to someone who specialises in figuring out the good managers to pick. But what is the big disadvantage of a fund manager? Fees, transaction costs, right? You're paying money to the fund manager and money to the funds that the fund manager invests in. You might invest passive or active. If you invest passive, you could invest in index funds, you could invest in exchange-traded funds, which are mostly passive. There are some active ETFs too now. Or you could invest in index futures if your mandate allows you to do so. They're all very easy to do, and they're all very low cost compared to your active strategies. If you want to invest active, you could invest in a long-only strategy, so you only buy shares. So there you're trying to buy undervalued shares and you'll later sell them when the value goes up. An active extension puts all of their own money in undervalued shares, then purchases another 30% of undervalued shares, and they fund that by short selling 30% of their portfolio value in shares they think are overvalued. That's how they raise the money. So they have a little bit short and a lot long. And a long-short hedge fund has full flexibility to go short and long. They can have equal positions in long and short positions. So they might, short sell $100 million of stocks they think are overvalued, and they might buy $100 million of stocks they think are undervalued. And then in your other, you have things like enhanced index. So this is basically a passive fund, but they take small active positions around those active passive weights. So it's relatively low cost. It will give you a return very like the index, but ideally with a tiny bit of alpha over the top. You've got the different smart beta strategies that we talked about last week as well. And remember, we defined each of these at the end of last week's lecture, or in fact, we talked about it in the workshop. So you can see there's a whole bunch of different ways to access your equity markets, and they will have different risk and return